Hello, everybody, and welcome to our webinar on taking control of your retirement funds with a self-directed IRA. My name is Larissa Greene, and I have my colleague Corey Daharsh joining me today. We're going to talk about really sort of the 101 type of information for self-directed IRAs. So we're going to cover the types of accounts that can be self-directed. We're going to talk about the rules for self-directing, and we also have an example for you. Again, my name is Larissa Greene. I'm going to be co-hosting this with Corey, and I have been with the company for 10 years now. When I started, I was doing back office work that included opening new accounts. I was covering things like transactions for the business. I included including things like coding checks for incoming income on retirement accounts, so rental income, interest payments, dividends, things of that nature. And now I've been in business development for a little over 8 years, so I do a lot of networking with the company and teach a lot of classes, just like this webinar that we're going to cover today. And like I said, joining me is Corey Daharsh. How are you doing today, Corey?
Hey Larissa, thank you. I'm doing well. So for everyone, I've been with Advanta for about 5 years myself. Similar to Larissa, I started in our accounting department handling transactions. Then I moved to account management, actually processing investments. Sorry, there's some feedback. And at this point, I've been on the business development team for about a year now, processing kind of moving into a new area and helping build a market in my new hometown and just networking and getting out there that self-direction is an option and something you can take advantage of.
Great, thank you so much, Corey. And I do want to point out before we go on that we are going to take questions throughout the webinar, so please feel free to send your questions over to us. We keep everybody muted for the sake of the recording and to keep the webinar nice and clean, but we do take questions through the chat box, so go ahead and send any questions that you might have directly through the chat box, and we will get those answered for you. A little bit about Advanta. We are a self-directed retirement firm, but we also do hold a couple other types of accounts that we're going to cover for you today. We can help anybody anywhere, but we do have 2 offices. I'm located out of the Largo office, which is really Largo, Florida, which is really sort of our corporate headquarters, meaning that we process all transactions, receive checks, and all of the stuff that goes into self-directed IRAs here at the Largo office. We also have an Atlanta, Georgia office, which Corey is based out of, but he's actually in North Carolina. So really just the point being that we can help anybody anywhere. So if you'd like to self-direct and you're in California or you're in New Mexico, we can absolutely help you. We even have clients that don't live within the US, they just have a US based retirement account, which is really all it takes to self-direct your IRA. So we have been in the business for a very long time at this point, almost 20 years. And we have over 2 billion in assets under management. What sort of sets us apart from our competitors is that we do provide everybody with a dedicated account manager, and that individual is with them for the life of the account. So, whether you are investing in cryptocurrency or real estate or maybe both, you're going to always work with the same person, and that individual can help you with questions on the rules, questions on how the process will work, and all the way through to making contributions to the account. So that is really a huge advantage when you're dealing with Advanta IRA, and you're going to find that our competitors do not handle their process the same. I also just realized too that Corey did upload the slides in the handouts section. So if you guys would like to download the slides, you can do that. Go to your navigation for the webinar and click on handouts, and you'll see it there as a PDF. So you can download that and follow along or keep it for your records. Slide. A little bit about what we do is that we are going to cover the rules. We're going to talk about the processes for self-directed IRAs and where maybe those rules get into a gray area. But something that we cannot do is give tax, legal, or investment advice. So if you say to us, hey, will this work within the rules? We can either tell you yes, it will, or maybe this is a gray area and you should get an opinion from a professional. But something we won't do is if you ask us, hey, is this a good investment? Can you do due diligence on it? We're going to say, unfortunately, that's something that we're going to direct you to another professional to do. And certainly ask your question anyway. And if it's something that we can't recommend or, something that we can't answer, then we definitely can refer you to some professionals that have helped our clients in the past.
Yeah, and actually I wanted to add in that the answer that Larissa just gave about this disclaimer kind of goes through for the question that we currently have. Someone posted that they were told they needed to get an operating agreement before they started a self-directed 401k. And can we provide recommendations? Yes, we can provide recommendations, but we do not provide a template operating agreement. We can definitely refer you to sources that our clients have used in the past, but you don't necessarily need an operating agreement for a self-direct 401k. It really depends on the way you'd like to structure it. That's something that if you reach out to us afterwards, we'll be happy to answer further and kind of give you the gist of which option you would need the operating agreement, which option you wouldn't. But establishing the retirement account in itself does not need to have the operating agreement set up first. I hope that answered properly for that first question we've got. And then I will bump it to the next slide. Thank you, Larissa.
Thanks, Corey. So just some key points, because what we're going to share today is just a lot of information, especially if you're not familiar with self-directed accounts. And so, what we always like to remind everybody is that there's just really some key takeaway points. And then from there, you can always reach out to us with questions, and we encourage you to do so. So, 1 point, any IRA or former employer plan qualifies. So, if you have an IRA, you're going to transfer it over to Advanta. It's going to retain its tax qualified status. So the status of that account is not going to change. This is not a taxable event. And any former employer plan qualifies, and we're going to talk about why it's former employer plan, when do current employer plans qualify. So we'll talk about that in just a minute. You choose the investment. So as a reminder, we don't do any due diligence, but that means we also don't sell any investments to you as well. The point of this account is for you to find those investments and direct us to make those investments on your behalf through the retirement account. And then another key point is that all expenses are paid by the IRA and any income is received by the IRA. And you're going to see that that is very important when it comes to keeping that tax status on your retirement account. So we want to make sure that we're doing everything within the rules. And that is the purpose of the administrator anyway, is for us to assist you in paying expenses, receiving any income. And so you don't want to do any of that outside of the retirement account.
And Larissa, before I flip to the next slide, we did have a second question. Are you the custodians of the self-direct IRA? You pretty much just answered that, but you used the word administrator. Do you just want to clarify that for that second question?
Yes. So custodian, that term does get used a little loosely. We are an administrator for the IRA and 401k, meaning that we handle the record keeping for those accounts. So we're going to hold the account. We're going to make sure that it stays within that tax qualified status, and we're going to help you make those investments properly through the name of the IRA, receive the income, pay the expenses. We do have a custodian that oversees our compliance, and so there is that sort of second layer to the process, but your account essentially is overseen by us, and we're going to help you. Your relationship is with us, and we're going to help you with those investments.
Perfect. And real quick, Larissa, are you hearing static when I'm speaking? Because I'm hearing it on my end, and I wasn't hearing it before we started when we were talking. Is it just coming through to me?
There's no feedback, so you're okay. There's no feedback on this side.
Okay, awesome. Thank you for clarifying. And with that, I will take over for a few slides here. I just wanted to let everyone know that there are plenty of types of self-direct plans you can utilize. Most people are commonly familiar with your traditional and Roth IRA, but there are also plans called a simple and a SEP IRA that you could utilize. Rolling over from a former employer plan is a big way that most people get started in self-direction. And then we also offer individual 401k plans for small or solo business owners, health savings accounts if you've got a high deductible health policy, and also education savings accounts if you're looking to set money aside for your children for their future or current education expenses, that you can actually self-direct those types of plans as well. Now, jumping specifically into that first and most commonly known type of retirement account, the traditional IRA, pretty much anyone can have a traditional IRA. As far as contributing, you do have to show earned income in that calendar year to make your eligible contribution. The limits may vary depending on your age, but they're typically standard around $6,000 with an extra catch-up limit of $1,000 if you're over age 50. And the benefits of a traditional IRA include tax deduction when you make the contribution. The growth is tax deferred until you take that money out as a distribution later on in life. And as I mentioned previously, you can roll over a former 401k plan into a traditional IRA. That is a majority of what we see clients doing. If they've left an employer and want to take that money in their previous employer's 401k bucket and create their own bucket or their own diversified portfolio of retirement investments, that's really how most people end up getting started. Building that retirement savings without having to take the tax consequence at this point is a great way to get started. And if you did want to take the tax consequence now, that is the Roth IRA account, which I'll go over here. Yes.
Before you go on, I just want to point out that, we mentioned former employer plan and we sort of put emphasis on former. And really just the reason behind that is that once you've severed ties with that employer and you're no longer a participant, you can always take the funds and roll them into another retirement account. That is sort of the rule. But if you're currently employed, you're currently participating in that plan, the chances sort of go down, if you will. And the reason is because when you're participating in the plan has rules, and the rules may not allow you to do what they call an in-service rollover or an in-service distribution. And so you would have to check with the employer plan to see if they allow it. And typically they have a triggering event that allows that rollover. It might be once you reach a certain age, a certain number of years of service. And so that's always going to be specific to the plan itself. And so when you reach out to us, we'll kind of explain that to you, but it's always going to be up to you to reach out to that plan and find out if it's going to allow you to move the funds. Now, more recently, I'm seeing more and more plans allow you to make those changes while you're still employed. They may allow you to move a certain portion of the funds, or maybe employee contributions or employer contributions. And so it's a great question, but it is a question for the plan administrator.
Thanks, Larissa.
Mm-hmm.
So jumping back in for the Roth IRAs, the same criteria for traditional. Anyone with earned income can have a Roth IRA. There is a contribution limit eligibility where if you earn too much in a given calendar year, you may be disallowed from contributing. We do have a little asterisk there. That would still allow you to contribute to a traditional IRA and then convert those funds over to Roth. I know Larissa's done strategies or webinars on similar strategies like that as to, getting money into the retirement product and then converting it to the exact product you'd like. Those are on our YouTube channel, so this is kind of a little plug to go check that out if that's of interest to you. And the benefits of a Roth account are that your earnings are being created completely tax-free because you've already paid taxes on the money you've put into that Roth account. So you don't have to get taxed when you do withdrawals. There are no mandatory withdrawals on that money later on in life. And if you expect to be in a lower tax situation this year and higher taxes in the future, considering a Roth IRA is probably a good idea for you. Again, as Larissa mentioned on our disclaimer slide, we always insist that you do your own due diligence and consult with your own CPAs and tax professionals to make sure you're putting yourself into the product that fits best for your needs. And again, with the conversions, you're able to maximize your non-deductible traditional IRA contributions and basically convert those over with no limitations to a Roth account just by filling out, in our case, just a one-page Roth conversion form to Advanta. We handle the paperwork, we handle the proper reporting, and that's what we do as the administrator of the account. It allows you to pay those taxes now in what could likely be a lower tax year for you than in the future. And again, some of the reasons to convert are when you think you're in a lower tax situation, when you think your taxes are only going to get higher in the future, and also to generate the earnings for the investments you're looking to make in a tax-free capacity rather than tax deferred where you're paying that later on. And Larissa, someone did post that they're hearing feedback. So while you're doing these next few slides, I'm going to try to change over my audio. So just bear with me. I'll try to do that as promptly as I can while you're presenting the next few.
Okay, no problem, Corey. And I also just wanted to point out on the Roth conversion, because I think I get this question a lot, and I'm sure Corey does as well. How are the taxes paid? And so really, I want you to keep in mind that this is a tax burden to you at the time of conversion and not to the IRA. So the IRA is not paying the taxes on the conversion. That's very important because a lot of times people say, well, I'll just do a withdrawal to pay the taxes. And that is not how it works. I guess ultimately you could take a distribution, but the taxes aren't going to just be paid by the distribution. You're going to have another tax for the distribution. You're going to also have a penalty for taking that distribution, very likely. And so that's something to keep in mind. The way the taxes are paid is that it is paid to by you through a 1099 issued to you the year of the conversion. So if I do a Roth conversion now in February, I'm going to receive a 1099 at the end of the year for the amount converted so that I pay the taxes on that amount as ordinary income. So that is how it works. It is brought into ordinary income to you the year you do the conversion. So we're going to go on here. And again, I just want to remind everybody that if you have questions, please type them into the chat box and I will help you with those. Corey, we went ahead a slide there. Can we go back one slide? Yes, perfect.
I'm so sorry. I couldn't hear anything while I was reconnecting my audio.
Okay, gotcha. Let's go to slide 10.
Okay, I'm sorry.
Yeah.
There we go.
Okay, that's okay, perfect. And you sound really nice and clear to me now. So I don't know if that fixed it on the viewer's side, but you sound good. Yep, we got it better
Perfect.
there.
Thank you so much. And I apologize for everyone that we're dealing with that. It didn't sound staticky until we actually started the presentation, and I appreciate the individual that let me know that from the question block.
Perfect. Thanks, Corey. So we're going to talk about employer-based plans now. And I know a lot of times people say, well, I don't have an employer. What we're talking about here is those people that are individual business owners or sole proprietors. And you can have these types of plans. Now, certainly larger employers also have these types of plans as well. But as sole proprietors, independent business owners, you can have a SEP IRA, a simple IRA, or a solo 401k. And so, you know, we're just putting this information out there for you so that you can talk to your CPA and see if one of these plans might be the right plan for you so that you can make larger contributions on an annual basis, take a bigger deduction each year, maybe for yourself and for your business or your business, depending on the type of plan. And so it's definitely something to look into because I think we all sort of default to a traditional IRA because that's the most common plan. But as a sole proprietor and independent business owner, these might work for you as well. So again, you're going to have a larger contribution on an annual basis. It's going to offer tax deferred and in some cases tax-free growth, and we'll talk about that. You're going to get a deduction for yourself, sometimes for yourself and your business, or sometimes just for your business. We have plans like the solo 401k that offer larger contributions based on the formula, and there also is an opportunity to make contributions to the Roth portion of the 401k. So we're going to talk about that. Slide. So in some cases, you do have to consider whether or not you have employees. So for a lot of you as an independent business owner, you don't have employees. It's just you or you and your spouse or you and a business partner, for example. And so if you have no employees, then you really don't have to worry about these considerations. But if you do have employees, you do definitely want to consult a CPA and see if those employees would be eligible for participating in the plan. And in some cases, if they are, then we would not be able to assist you with that plan. And so we're talking really about individuals under the 21 that may be excludable. You may also be able to exclude non-resident aliens and union employees. But again, you definitely want to check with a CPA if you have employees outside of your spouse or a business partner. So business partners are a little bit different. Again, reach out to us if you have business partners so we can talk about that. But ultimately, you would be eligible for these plans. A SEP and a simple you are always eligible for, even with employees, but whether or not you have to include them in contribution limits is really what you want to look at. And then again, for the solo 401k, you can see we have it listed here who may or may not be eligible to participate. And then in that case, you would not be eligible for a solo 401k. So basically meaning that a solo 401k plan is just set up for the business owner, partners, and spouses of business owners and partners. Outside of that, a solo 401k would not work. But a SEP or a simple definitely would. You just may have to include those employees. Slide. So what is the advantage to having a SEP or a simple IRA? Well, they are definitely less expensive than a full 401k plan. If you have employees and you're looking for a plan that you do want to include employees in, this might be something to look at because a SEP or a simple are far less expensive to administer than a 401k. Contributions are easy. They're made to the IRAs directly. There's no fiduciary liability like there might be with a 401k. The individual employee chooses their own IRA custodian. So I actually just spoke to a potential client about this the other day. When you have a SEP or a simple, you establish that plan by the forms that are provided by the administrator. And then from there, your employees can set up their plan or their account wherever they like, and they just notify you so that you can make those contributions on behalf of the plan. So if you want to self-direct your SEP plan, for example, but your employees don't want to self-direct, they can go and have a brokerage type of account anywhere, Fidelity, Morgan Stanley, Charles Schwab, any of those brokerage houses, and they just let you know that they're going to establish the plan. You provide them with the plan document, they set up the account, and then give you the information to make those contributions that you make through payroll or what have you. And they can do that while you still self-direct. So that's very flexible as far as options for investments. The contributions are very flexible. Let's say that you don't have any employees and you have a SEP plan and you want to make your full contribution, and we will talk about contribution limits in a few minutes. But you want to make your full contribution of, say, 25% of your annual income, you can do that now. You can do that throughout the year. You can do it at the end of the year. The contributions are going to be very flexible there. And again, here is the information on who you might be able to exclude: 2 years of service for a simple IRA and up to 3 years of service for the SEP IRA. And again, we always recommend that when you have employees, you involve your CPA to make sure that you're setting up that plan properly and including who might be eligible to be included. Slide. So with the solo 401k, Corey, did you want to cover this one or did you want me to continue?
You can continue. I'm sorry.
Okay, that's okay. So with the solo 401k, this also has a lot of benefits. And when we get to the contribution slide, we'll point out how the solo 401k is different than the SEP IRA, but ultimately you're going to have higher funding limits. And although both the solo 401k and the SEP IRA are $61,000 for the year 2021 or 2022, so the annual contribution does seem the same. Both of those annual contributions are arrived at based on a formula. So with the SEP IRA, you get 20 to 25% of your income, and it's an employer contribution. With a 401k, it's an employer and employee contribution. And so when you use that formula, a lot of times with the 401k, you're going to get a higher contribution. So if, let's say we take $100,000 annual earnings for 2022. With the SEP IRA, if you could max out that contribution, and it does depend on how you file, and you could put 25% in, then you as your own employer could put $25,000 in. But if you're using the solo 401k, again, you as your own employer could put $25,000 in based on $100,000 in earnings for the year. But then as your own employee as well, you get that other contribution of $20,500. And so you would get the combined total of 25,000 plus 20,500. So you're going to get 45,500 in on an annual basis with the solo 401k versus the 25,000 of the SEP. Now, one plan over the other makes more sense depending on what you're looking to do. The 401k is more expensive and it is more complicated to administer, and you get less administration typically from a 401k plan administrator than you do with a SEP. So for example, with the SEP IRA, we keep record of that automatically. It is, we do all the annual reporting for that, and you're just paying the fees of an IRA. When you go to a solo 401k, depending on the plan you choose, we do have a full service option, but it is going to be more expensive. We also have a do your own option with checkbook control, which is just a flat fee, a whole lot less expensive, but that means that record keeping is going to be up to you as the plan trustee and plan reporting. So that kind of gives you the pros and cons of those one versus the other, so to speak. With the 401k, you do have access to tax-free loans, which is different from an IRA. You cannot borrow money from your IRA, but with a solo 401k, you can borrow. It is called a participant loan, so some of you may be familiar with that term. You have flexible distribution options. It is cost-effective administration as far as other 401k plans, but it is going to be more expensive than a SEP or a simple. And you have the option of making Roth contributions to the 401k. We have webinars dedicated directly to 401ks because there is a lot of information that goes behind them, so I'm not going to get into that now. But again, you do have the option of having Roth contributions in the 401k. Slide.
Yeah, I'm actually taking over for this slide, but before I really get started, I kind of wanted to add one quick piece based on the first question we got of the day about having that operating agreement set up before you make any investments or set up a self-directed 401k. The option type that Larissa just mentioned as the do your own plan is really a 401k plan that I consider like a bare bones model. And in that context and for that plan, you actually do not need to establish an LLC or a operating agreement for that matter. You simply just have to have that do your own 401k plan established, and you open a bank account in the name of that 401k directly. So no actual LLC is needed. I kind of alluded to reach out to us later, but I figured with the end of Larissa's last slide, that would be a good place to kind of interject with that answer and that additional feedback as well. Larissa, any further words on our DYO plan or comparing, I guess, that to the full service in that context?
No, I think that was a good point, though, Corey. Certainly, you could have an LLC when investing through your do your own plan, but it is not required.
Awesome. All right, so the next plan type that I'm going to go over is the health savings account. Health savings account is a tax advantage savings account for individuals and or families that have high deductible healthcare plans and that can be used for a wide variety of future or current medical expenses. It's considered triple taxed because you're actually making the contribution tax deferred, the earnings of your investments grow tax-free, and as long as you're taking those earnings or any funds out of that plan for a qualified medical expense, the money is also distributed tax-free. So again, it takes you and or your family qualifying for an HDHP plan, but if you do and you are already interested in self-directing, this is a really niche type of account that you can really take earnings of and just really grow and protect yourself for future medical expenses that you may have building up in later on in life. So like I just alluded to, there is an individual coverage HSA account, and there's also a family coverage HSA plan. You do not need to have one or the other. Whichever one actually fits you or your family's needs, that's the one you would really want to go with. With having a high deductible health plan, there are no co-pays for office visits or prescription drugs other than preventative care until you meet your deductible. And preventative care includes annual physicals, prenatal and well child exams, immunizations, and other certain screenings. For 2022, the respective deductible limits are $1,400 and $2,800 for self-coverage or family coverage. And after that, out-of-pocket maximums for self-coverage are $7,050, with family coverage being $14,100. You can have other health coverage. You cannot have other health coverage, but you can have vision and dental plans, long-term disability insurance, or workers' compensation. Individuals that qualify for HSAs cannot be enrolled in Medicare, and you cannot be claimed or listed as someone else's dependent if you're looking to take advantage of a health savings account. Some additional requirements. There's this rule called the first day of the last month rule, and it basically means you have to have the plan established and active for a full 12 months. So, for example, I'm not going to read through that whole paragraph of explanation. I don't think anyone's here to watch me read the slides. But for example's sake, if you opened your plan on November 30th of 2021, you can make your full contribution to the account for 2021 and take advantage of the deductions on the returns. But if he loses the coverage before the 12 months is up, so basically the same date of the following year, you must take prorated distributions from that account, and those distributions would also be subject to taxes and a 10% penalty. So it is important to make sure you keep that coverage if this is a strategy you're looking to utilize, so that you can avoid those penalties for the sake of trying to get in this better tax advantage type of account.
And we had a question pop up on what is considered a high deductible. So typically what I tell people is check with your plan. I mean, of course, there's a lot of things that we would probably consider a high deductible, but if you're looking to start an HSA, the best thing to do would be to check with the plan itself and make sure that you can contribute to an HSA. And go ahead, Corey.
There was a I just saw what amount, excuse me, has Congress stopped backdoor transfer to Roth IRAs? I don't believe that's something that's been stopped, and I know that you've done an awesome webinar on the backdoor Roth conversion, so I'll let you take that one.
Yeah, so I know currently there's talk in Washington, of course, about sort of putting an end to the backdoor, but they have not done that yet. So we haven't had any clarification, and there hasn't been anything, solidified. But there is talk about stopping the backdoor Roth IRA. So for those of you that are not familiar, it's basically making a contribution to a traditional. If your modified adjusted gross income is too high to contribute directly to the Roth, and then simply converting that amount. So that's what we consider a backdoor Roth contribution. We do have a webinar on that, and it is currently still allowed. And so if there is any changes, certainly we'll probably do a webinar on that, but currently you can still make the backdoor Roth contribution.
And one other aspect I'd like to add real quick before you jump into the covered else, Larissa, just to that effect, with any pending legislation that involves self-directed investing or our industry in general, types of investments you're allowed to make, we try to be on the forefront of educating our network to those things. So if you are here watching this webinar or participating and you're not an active subscriber of Advanta's content, please feel free to check us out so that you can be aware and on the forefront of any types of decisions like that are being made. When we had the first rendition of the Build Back Better bill a few months ago, we put out a change.org petition and a lot of push to get some of the things that would have affected our industry in a very negative capacity taken out of that legislation. So if that's something that's important to you and you're very interested in, feel free to keep an eye on our content. We'll always be, putting that out as best as we can and as quick as we can as anything comes to play.
Yes, that's a good point. Thank you, Corey. And it's very easy to subscribe to our newsletters. Just check out our website, go all the way to the bottom and enter your email address. But if you're on this webinar, you are very likely already subscribed. But yes, that is a very good point. And stay with us on that, because if there is an update on whether or not backdoor Roth contributions are allowed or changed in any way, we'll keep you informed. So I had another question about getting the slides plus the playback. Yes, the slides are actually uploaded right now. If you go to the navigation bar for GoToWebinar, as you're watching this, you'll see a spot that says handouts. In the handouts, you'll see the slides. You can download them from there. The recording will be sent to everybody that registered. Just usually by the end of today or tomorrow, you'll get the information to your email. So you'll get that link. We're going on to Coverdell Education Savings Accounts. We call them ESAs around the office. Sometimes they're called CESAs or CESAs, but we basically don't see a lot of these accounts. They're great accounts. They're awesome for saving for current and future education needs. But unfortunately, the contribution is only $2,000 a year. It hasn't changed in all the years that I've been with Advanta, and so we don't see a lot of them. Sometimes people say, "Well, how can you, grow this account starting with just $2,000?" But I will tell you, we do have clients that have them, and they definitely are able to self-direct and grow these accounts. So they definitely could be a benefit to you. Like I said, we call them ESAs, but they're also known as Coverdell Savings Accounts, Coverdell Education Savings Accounts. And they are very similar to a Roth IRA. So meaning that when you make the contribution, there is no deduction for making that contribution. The money simply goes in after tax, but it does grow tax-free, and it withdraws tax-free as long as it's for qualified education expenses. So there is a list of qualified educational expenses, but that includes things like tuition, books, and fees that are associated with qualified elementary, secondary, or higher education. These accounts are a little more liberal than a 529 plan, meaning that your qualified expenses, the list is a little bit longer. So you're going to get to take distributions for things that a 529 plan would not allow. Another great thing about these accounts is they can be passed to other beneficiaries, meaning that I have 3 kids. And so let's say that my son has an ESA and he is the oldest. When he reaches college and finishes college, if he hasn't used the whole amount in the ESA over the lifetime of the account, before he reaches age 30, I can pass that account to the next sibling. So my daughter, the middle child, she can now take on that ESA account as her own. And from there, if she doesn't use the whole account, I can pass that again to my youngest. And so that is a great account for saving for educational expenses, not just for one child, but many children over the course of that account's lifetime. And so it can be a very beneficial strategy for saving and growth tax-free. Once the final beneficiary of that account reaches age 30, it is distributed and taxes are paid. So that is important to note, that if by the time that the owner of that account reaches age 30, if the full amount isn't either moved down to another beneficiary or distributed for educational purposes, it is taxed at the time of distribution. So I kind of already went over this, but unused funds can be transferred to another eligible family member. I think a question I get a lot is, well, who is considered an eligible family member? And in the rules of the IRS, actually a lot of individuals are considered eligible. So it can be siblings, and it can also include certain cousins, and oddly enough, even aunts and uncles. So if you have questions on who these funds can be transferred to, please let me know. Most recently, when I looked it up, the list did go on and on. So I think that is good news for the ESA, but it does have to be transferred before the current owner turns 30, and it can only be passed to another individual that is under the age of 30. Contributions can only be made up to the current holder's age of 18. So once that individual reaches age 18, contributions can no longer be made. And then, of course, at the time that the owner turns 30, the account is taxable to that owner and may also be subject to a 10% penalty. Slide.
Well, actually, I wanted to add one other thing, Larissa, about who is able to make the contribution into these CISA or Covered L Education Savings accounts, because it does not necessarily have to be you, the parent of the child. This could be something that you set up if you'd like your parents, the children's grandparents, to contribute and help benefit their future. I've seen plenty of clients actually reach out, set up accounts, and it's actually the grandparent that makes the annual contribution into the account for the child's future. So I just figured I'd mention that as well, in case that's something that some of you might be thinking about. I know Larissa mentioned she has young children. I have a young child as well, and it's always good to have that in your pocket to say, hey, grandma or grandpa, this is a nice way to do a little Christmas present, or what you will for birthdays and whatnot. So just something else to consider.
Perfect. That's a good point. Thank you, Corey. So now we're going to cover the contribution limits. And so, I made this point a little earlier, but depending on the type of account that you're looking for, you could really maximize your contributions. And we're really at a great time of year, because pretty much all of these accounts can still take contributions for the previous year, and most of them can still be open and funded for the previous year. So the only one that I can think of that cannot be still established and funded for 2021 is going to be the Simple IRA. You can still certainly make contributions to your Simple if you have it for the previous year, but you cannot establish it. The deadline to establish it was actually back in September for 2021, so it cannot still be opened and established, but it can be contributed to. Every other account that you see up here can still be established and contributed to for 2021. You're going to have some exceptions with the 401k. It really should have been established as of December 31st, and your employee contribution should have already been made for 2021, but you can still open and fund for the employer contribution for 2021 with your solo 401k. So if you haven't established that account, not all is lost. You can still do that and still make a portion of that contribution. Your traditional Roth, SEP, ESA, and HSA accounts can still be open and funded all the way up until April. I believe it is actually April 18th this year for 2021. So that your tax filing was extended to April 18th for 2021. And so then your contributions have been extended as well. The solo 401k contribution, as you can see for 2022, the limit is 61,000, as is with the SEP. But remember, we talked about that formula for contributing. The SEP IRA contribution is an employer-only contribution, but when you have a SEP, you can still also have a traditional or Roth IRA and make that individual contribution as well. With the solo 401k, you have your employer contribution and then your employee contribution, and the total combined on those cannot exceed 61,000. And our 401k plan also does allow a third type of contribution called an employee non-Roth after-tax contribution. And so again, if you have questions on that, please reach out to me. But then you also see the list of contribution limits for all the other types of accounts, and you can see where if you're a independent business owner or a sole proprietor, it benefits you to have a SEP, a simple, or a solo 401k. You can also possibly have a traditional or Roth with some of these accounts, so just reach out to us and we'll talk to you about that. And then you see the ESA contribution is $2,000, as I mentioned, per year per child. And you have your HSA contribution limits listed here. If you're still making contributions for 2021, those contribution limits are going to be different for most of these accounts. The only accounts that did not change for 2022 are going to be traditional, Roth, and then of course the ESA. So if you're still making last year's contributions, you can check out our contribution page on the website at advantaira.com or send us a quick email and we can provide you with the link. Slide. So we talked about contributions and how they're limited. And when we talk about contributions, we are literally talking about money you take out of your pocket and put into the account each year. What we're not talking about is earnings. Earnings are unlimited to the IRA account. So if you make a contribution to your solo 401k, let's say, of $20,000 this year, and you lend that money out and you're participating in a joint venture, and let's say 20,000 really actually maximized the contribution that you could make to the solo 401k this year, but those earnings are coming back to the solo 401k, and at the end of the year you'll have 25,000 in that account. That is not going to count against you. That's not going to count against your contributions because that's earnings to the account, and so those earnings are going to be unlimited. And that's important because a lot of times people say, well, I can only put 6,000 into my traditional IRA this year, but this investment I'm going to make has much more earning potential. What can I do? And the fact is that your contribution limit is only limited on the amount of money you take out of your pocket and put into the account. Slide.
So everything we've been talking about with self-direction here, maybe something you have heard of or something you haven't. It's important to note that only about 4% of the retirement industry in the US is self-directed. And mostly we see the reason behind that is because common IRA administrators only offer limited products and want you to stick with those limited products, or people just haven't had a chance to hear from someone like Advanta that are a proponent of this industry and trying to get the word out there and educate individuals that this is even allowed. So we do a lot of education, networking, and trying to expand the knowledge of self-directed investing. We hope that you're benefiting from this and you in turn carry on and tell people that you know to check out either this webinar directly or any of the future webinars or past webinars we've done that are currently hosted on our YouTube channel for any specific topics or interests that you may have. But it is, again, 4% of the current IRA industry or 401k industry in the US is self-directed, which is a significantly low number given the flexibility and freedom that these types of plans allow. Speaking of the flexibility and freedom, I do want to go over the restrictions of self-direction, which really aren't too restricted when you think about it. The only types of investments that are prohibited are investing into a life insurance policy or hard to value collectibles are deemed by the IRS hard to value, such as antiques, alcohol, artwork, stamps, and some coins. There are some coins you are allowed to invest into. We have a special page on our website that breaks down precious metal investments that are allowed. So feel free to check that out if you're interested in those types of assets. Prohibited transactions specifically, for the most part, deal with transactions you're doing with prohibited individuals or disqualified persons, which really boil down to your lineal descendants and ascendants, meaning your children, your parents. You're not allowed to buy or sell or deal with them on the opposite side of an investment transaction. You can certainly partner with those individuals that would otherwise be considered prohibited. And if you're interested specifically in the nuts and bolts of these rules and regulations, that is section 4975 on irs.gov. That breaks down all of the IRS's rules and regulations about self-directed investing. Advanta has most of our staff go obtain what's called a CISP designation. Larissa and I both hold a CISP designation, meaning we spent about a week-long time taking a course and dealing with other individuals in our industry to learn the ins and outs of those rules. So while I do point out that specific area of documentation from the IRS, we are an open resource as well to reach out to us and ask us any questions you have, whether it be about a specific investment or rules and regulations of things that you're considering. And the final aspect here is UBIT or UDFI tax. They are not commonly known or, I guess, dealt with taxes in the industry. For the most part, it comes into play when a passive investment starts doing things or generating income that is not necessarily as passive as others could be. And then there's also unrelated debt financed income if you're utilizing leverage for any aspect of investing you're doing. So for example, if you're looking to purchase a property within your self-direct account, there is a certain type of tax that is paid on the portion of the investment that is leveraged. We have special section on our website that goes over UBIT and UDFI, and I believe one of our colleagues recently did a webinar on that topic in itself as well, if you're interested in those types of things and that specific type of investing.
And we had a question pop up about moving over to a self-directed IRA and whether that was taxable. When you're moving like IRA to like IRA, that is not going to be a taxable event. So if you have a traditional IRA, we will open a traditional IRA for you with Advanta, and we will help you transfer those funds. It's a very simple process, and we will walk you through it, and that is not a taxable event. If you move from a traditional IRA, for example, to a Roth IRA, that would be taxable, and that would really only be at your discretion. We are certainly here to help you move your account without tax consequences, and then we hold it and so that it remains in its tax qualified status. And so it is not a taxable event, and we walk you through the process. You're not, sort of left on your own to figure it out. You can reach out to us and we can help you with that. Thank you for the question.
Yeah, furthermore, 401k to Roth IRA is a context where you're taking tax-deferred money and putting it into a post-tax account. So that is another scenario like the traditional IRA to Roth IRA that Larissa just mentioned. And then I see another question as well about who can you lend money from a 401k to. Pretty much anyone that's not a disqualified person, as I just went over, and I will go over it briefly again in the next slide. But anyone that you would like to lend to that's not your children or your parents, it could be your neighbor, it could be a business partner, it could be a cousin for that matter. It can be someone in your family, just not necessarily anyone on your lineal tree, whether it's an ascendant or a descendant of yours. So this next slide, I'm going over here as far as working within the rules of the IRA or the IRS. You cannot sell, buy, lease, or exchange any investments with the IRA holder and a disqualified person or entities that they may own. So if you're thinking about getting around it by loaning to your son through an LLC he owns or something of that nature, that's what's called an arm's length or a step transaction. You may not get caught in the moment, but if you're ever audited in the future, that's something that would come up and would be a major issue at that time with lots of penalties and fees to be paid. Those are types of questions that if you do have them, that's what our account manager is here for, to be a resource for you to answer those questions. That's why we, in the most part, get our CIS designation, so we can be experts in that area and make sure you're not putting yourself in a negative or compromising position with your retirement account. And again, there are other ways that you can do investments with that person. If you think about it, closing on a piece of real estate, if you're sitting on the same side of the closing table with the disqualified person, that's partnering and that's perfectly allowed. But if you're trying to buy or sell and you're on the opposite side of the table from that disqualified person, that's where you're running into issues and prohibited transactions with disqualified persons. Another aspect, specific mostly for real estate, is that you cannot conduct any sweat equity on behalf of any IRA investments. So if you're a real estate investor and you're a flipper and you buy a property within your IRA and intend to go over in the evenings after your 9-to-5 day job and fix up the roof and change out the flooring and things like that, those are things that you personally cannot do because it is owned by your retirement account. Even if it's a partnership and you only own a portion of the property in your retirement account, it is prohibited for you as the IRA holder to do any sweat equity. The way around that for IRA investors is by having a good team of resources to conduct those types of duties and tasks and jobs. So make sure you have your contractors lined up if that's something that you're interested in, or that you're doing a partnership or a joint venture, that's someone that is not a disqualified person that can do that sweat equity on behalf of that partnership or that joint venture for the investment that you're trying to make. And again, I know I referred to it on the past two slides, but the prohibited disqualified persons include the IRA owner and their spouse, and basically their parents or their children. Business entities that are controlled by those individuals are also considered prohibited. Anyone else, as I mentioned, it could be an uncle, it could be a cousin. If they're in your family, as long as they're not on the up and down aspect of your family tree, you can do investments with them. It just is something that you want to, again, do your due diligence on. Make sure you've consulted with either your IRA professional or any legal professionals you have before you really set up the brunt of the deal to make sure everything falls within the compliance of the IRS. And based on the last few slides, I'd like to go over a few examples of prohibited transactions here. I'm not going to read every single one, but again, if your father's IRA lends money to you or your son, that is prohibited. If you own a property in your IRA and you'd like your children to live in it while they're in college, let's say you buy a property near the college your kids are going to go to, they cannot live in it. A workaround there that's not necessarily letting them live in it at all, but you could buy that property so that your children's friends could rent that property out, and you could build wealth and income that way by having trusted tenants that you know and that you would trust, but it's not necessarily someone that's prohibited or disqualified from utilizing that property directly. And Larissa, anything else about prohibited transactions? I think we're about to step into types of investments that can be made, and I think we'll follow that up with a brief case study example.
Yeah, exactly right. So we are going to go into that, and I did have a few questions here. So we are going to give an example of how you can purchase real estate through an IRA. So I did have that question pop up. It is possible. Can you lend money from a self-directed entity to something like an LLC? Yes, you can. And to Corey's point, you can lend to an LLC. That's absolutely fine. It cannot be owned or controlled by those people that are considered disqualified individuals. So anybody up and down your lineal tree, those people would be prohibited from either controlling or owning that LLC that you want to lend to. But if it's a friend's LLC, a financial friend's LLC, what have you, you certainly could lend to that LLC. Absolutely. It doesn't have to be directly to an individual. Who can you partner with? You can partner with anybody. You can partner with somebody that would be considered disqualified. So let's say that I partner my IRA with my son's IRA, for example. See, what we're doing here is we're partnering. We're either tenants in common on the deed, or we're both listed as the lenders, for example, and our percentage of ownership is just reflected by the amount of funds we each bring to the table for that deal. The deal is new to us and new to our IRA accounts, and so therefore that partnership is allowed. What I can't do is lend money from my IRA to my son's IRA, for example, for him to then in turn make investments. So partnering with anybody is allowed, but doing transactions with those individuals would be considered disqualified. So I'm just going down the list of questions here. So brothers, sisters, aunts, uncles, cousins, those people are not considered disqualified. What you want to be careful there is that if you're doing investment deals with them, if you're buying, selling, trading, exchanging with those individuals, that you're doing it for investment purposes. That's very important. We don't want you to say, have a property in your IRA and then lease it to your brother and he doesn't have to pay rent. Now that is no longer an investment for investment purposes, and you're getting into an area where the IRS, if audited, that transaction would likely be considered prohibited because it's not for investment purposes. There's some intrinsic value possibility for that investment, and that's what you definitely don't want to run into. So again, investments for investment purposes, even though those individuals are not considered disqualified, it could be considered a disqualified transaction. Let's see, can I partner with my IRA on an investment? Yes, you can invest alongside your IRA, so you can partner into an investment. Again, it must be for investment purposes. The IRA can always benefit. What you don't want to do is bring your IRA into an investment because you need it there. That might be considered prohibited. So if you're looking at partnering with your own personal funds, then what I would suggest is bringing in a professional to look at that strategy and structure with you to make sure that it's structured properly, and that if that transaction were audited by the IRS, that they would not consider it prohibited. So that's important. Can your IRA purchase a rental property that someone who's not related to you rents? What if it's like an Airbnb? Can you purchase a rental property? Yes, you can purchase a rental property from a non-disqualified individual. That's absolutely allowed. And can you Airbnb it? Yes, you can. The one thing that I would recommend is talking to a CPA about whether or not at some point, if you use Airbnb or short-term rentals in the IRA, if that UBIT tax that we talked about would apply, because I am not a tax professional. I cannot answer that question for you, but certainly that would be allowed. There's a question about annuities. Yeah, you can buy annuities in IRAs, but we simply don't handle them. So that would be for another type of IRA administrator. We had another question pop up about real estate and financing. Yes, you can buy real estate and utilize financing. Absolutely. It has to be a non-recourse loan, and you do expose an IRA to UBIT. So that tax that we talked about, it does have to be non-recourse. You cannot extend your personal credit or give a personal guarantee for those loans that are within the IRA, and you do expose the IRA to UBIT. There might be an exception for your 401k, but an IRA is definitely going to pay UBIT. Somebody is asking if we can go over UBIT again. We are time crunched here, so let's get through the rest of the slides, and then we'll go back to those questions for those people that want to hang around. But Corey, let's go to the next slide.
You got it. Thanks, Larissa, for covering those questions.
Yep, absolutely. And sorry that we're kind of fire sailing those, but we do want to be respectful of everybody's time. So we just want to go a couple more minutes here. The next few slides are just really covering the types of investments we see on a regular basis. And so I'm going to go over those quickly. But the whole point of this list is not to tell you what you can invest in. It's just to give you an idea of what we see very regularly through a self-directed IRA. But don't get me wrong, a lot of times we have people come to us and say, hey, can I make this investment? And a lot of times it might be something we haven't heard of, but it would work within the rules. And so, you know, looking at these, kind of hopefully getting your wheels turning as to investments that you would like to make, but these are not necessarily the only investments you can make. So again, purchasing property, whether it's single family homes, mobile homes, condos, mobile home parks and duplexes, all of those things would be allowed within an IRA. Real estate-based assets are the most common investments we see at Advanta. Slide. Certainly the other types of investments are going to include paper assets like lending out money, buying tax liens and deeds, unsecured notes. I know a lot of times people will say, well, I really don't understand why somebody would invest in an unsecured note. It seems like it wouldn't be safe. And you would actually be surprised that unsecured notes number a lot higher with assets that we hold at Advanta IRA than, say, first mortgages do. So I think that's always interesting to people. And of course, the higher the risk, the higher the reward, but again, the higher risk. So make sure you're doing your due diligence on your investments and feeling comfortable in those investments before making them. We see a lot of option contracts, and that also applies to real estate. We see assignments and joint ventures. We've also seen accounts receivable. So again, all things allowed within a self-directed IRA. Slide. So alternative investments also include things like LLCs, whether it's single member for the purpose of having an investment vehicle for checkbook control. And Corey and I actually did a webinar on that last month, so you can check that out on our YouTube channel. But it also includes things like LLCs for businesses. We also have seen investments into farm animals. I know that sounds very unique, but again, the advantage to having a self-directed account is investing in what you know best. I've had people invest in things like movie projects and precious metals. We've had large equipment leasing, foreign currency exchange accounts, and again, the list goes on and on, just to give you an idea of things that we see in a self-directed IRA. We had a question pop up about ETFs and REITs. Yes, those investments can be made. We can hold investments that are considered private. So I know sometimes there are real estate investment trusts that are considered publicly traded. We will not hold those here at Advanta. Certainly another brokerage firm could do that for you, but anything that's considered privately held is something that we can help you with at Advanta IRA. Slide.
Yep, this slide actually jumps into my example here of a real estate purchase within an IRA. Just before I get that started, I'll answer this relevant question. Can the self-direct IRA buy a remainder interest in a single family home? The answer is typically yes. The self-directed account can hold any percentage interest in a home. The issue that could come at play there is if it's buying that interest in the home from you, a disqualified person, or any other disqualified persons. So if you're looking to just purchase 10% of a property and it's coming from a non-disqualified person, then yes, that can definitely be done. If it's going in as a new purchase, I've seen clients in their retirement accounts hold a 5% interest in a property while they as individuals hold the other 95% interest in the property. And again, I'll kind of allude to that and go into that a little bit deeper as I get started with this example here. But I do, again, want to be mindful of everyone's time, as Larissa mentioned. So let me jump right in. In this scenario, we've got Joe, who's a real estate investor. He's got $150,000 in a traditional IRA, and he wants to invest into real estate. He decides a single-family rental is the best type of property for him, and finds a home valued at $100,000, or that he can purchase for $100,000 rather, that needs about $20,000 of work to get it rent ready. Once that is rent ready, he projects that he'll make about $1,000 a month on the property, so cash flowing $1,000 back into the retirement account. How can Joe buy this property? Well, he comes over to Advanta, completes our application, takes about 15 minutes, sets up the account, gets that $150K moved over from his previous custodian, which we will also help with, and then gets the contract for the purchase of property issued in the name of his retirement account. That's very important that this goes through the retirement account as the buyer, so that the deed that's recorded on file with the county lists the IRA as the owner and also lists the proper tax ID number as to not have Joe's specific social security number associated with that real estate. So he gets that all set up by working with his client account manager, who makes sure all the paperwork's good to go, makes sure Joe approves everything and understands all aspects of the transaction. Basically, Joe marks everything as read and approved. Advanta sees to getting everything executed properly, having the closing documents get to the closing table, and also sending out the closing funds. Then the property is owned by the retirement account at that point. The work can be done and paid out of the retirement account for those $20,000 of repairs that need to be made. Those are simple. You have an online portal to submit your expense requests, or you could reach out to your client account manager directly. We get those paid within 1 business day of receiving the request to make any outgoing payments out of your account. And again, as long as you have the extra capital in the account, in this case, Joe had $150,000. You really only need to work with $120,000. It's important to note that you don't want to stretch yourself too thin, because if you don't have the money in the retirement account to cover the retirement accounts investments, then you might be stuck having to wait for next year's contribution to come in. Or, I've seen, unfortunately, situations where people didn't have enough money in their account to pay their tax bill, and then you get delinquent taxes and things like that. So always make sure you've done the due diligence and kind of underwriting per se, that you're not going to stretch your retirement account too thin before it starts cash flowing. And after the closing, Joe directs Advanta to get that property up to snuff for rental, gets the renter in the property so that that cash flow starts coming in at $1,000 per month. And from there, he holds onto the property for as long as he wants to. He can take it out as a distribution later on in life if that's something of interest to him. He can sell the property at really no tax gains, no capital gains taxes or anything like that. The taxes are either tax deferred if it's a traditional style account, or completely tax-free earnings if it's a Roth style account, whether it's a Roth component 401k or a Roth IRA account. It's just a really great way to turn an investment into something that can be much, much more after a little bit of holding in the case of a short-term rental or even a long-term rental property.
So getting started is actually really easy. I know there was a question on, well, how do you maintain the tax deferred or tax-free status of the account if you want to self-direct? It's just a matter of getting your account open with us. Corey or I can help you. We also have other associates you may be speaking with to get your account set up. We would just establish an account for you. And then if you're moving from an IRA, we're going to help you do that. So you're not going to request the funds. We're going to request them on your behalf. They're going to go from your other administrator and come directly over to us. That's called a trustee to trustee transfer. If it's an old employer plan, we'll walk you through the steps to get started on what's called a rollover. The money comes over and your account is funded and you're ready to start investing. So it is very, very simple. Slide. We have classes all the time. They are always no cost, no obligation. So we invite you to. We hope that you will continue to enjoy us for classes that we have. As I mentioned, if you are looking to learn about checkbook control, me and Corey just did a webinar on that last week or the week before, and so the recording is available on YouTube. So having a single member LLC or a trust for checkbook control, you can check that out. I have done webinars on solo 401ks, on mega contributions, and on real estate investing, private lending. So Corey and I will hope to be a resource to you, and we hope that you'll check out many of our other webinars there on our YouTube channel and the video library on our website. We also have a blog, and we will email you about current events. So as Corey mentioned, as things change in legislation, if there's anything that concerns our industry, we will let you know about it. So please make sure that you're subscribed so that you can stay up to date with us. Slide.
Actually, I wanted to add one thing real quick. It's not just Advanta associates that are doing these webinars. We very often bring in industry subject matter experts. I know there were a few questions about the non-recourse lending or debt finance real estate. I did a great webinar about almost a year ago with one of the nation's top leading commercial non-recourse lenders and also a real estate broker that's very familiar with non-recourse lending. So it is important to note we also have great guests that are not Advanta associates that help provide this education. We're always looking to network and meet new guests. So if that's something of interest to you and you are a subject matter expert, reach out to us and we'll see if that's something that we can put together with you as well.
Yes, exactly right. And here's our contact information. So I know there was a ton of questions that were really more specific to your current structure and strategy for investing. And so if you would like to go over that, we would encourage you to reach out to us. You can either reach me or Corey. There's our contact information. Please feel free to do so. Again, the recording will be out either the end of today or tomorrow. If you were unable to download the slides, you can email either myself or Corey, and we'd be happy to get that PDF out to you and again, answer any questions that you have. We also have our own networking events here at Advanta that are on Zoom, and we would love for you guys to have the opportunity to join us. You can go to advantaira.com/events and check out Pitch, Promote, and Prosper. That is every other Friday where we have a Zoom call, and everybody is welcome to either just listen in or pitch an investment that they have or what they're looking for to the crowd. And we also talk about current events there as well. Again, that's every other Friday. So that will not be this week. The next Friday that we have, that one is February 18th. So please join us on February 18th for Pitch, Promote, and Prosper. And you can find that at advantaira.com /events. And with that, I think we are ready to wrap up. Corey, was there anything else?
No, I think you covered it. Thanks for adding Pitch, Promote, Prosper to the end here. And again, we love doing these types of events and educating. That's really a key part of our business, is educating and passing along the information that we've gained to you so that you can either utilize it yourself or know to further educate those around you that may be interested in this type of investment strategy or these types of things. So it wouldn't work without you guys also participating and helping. So thanks for all of you that have either watched this recording from our YouTube channel at Advanta IRA. So just if you type in on YouTube, Advanta IRA, you'll find our channel. It's got plenty of videos there. This will be up, like Larissa said, within a day or so. And for those of you in the chat that have asked for copies of the slides, there are a few of you. I will check into that and make sure they get sent to you within a day or two. No worries. All right. Sounds like we're all wrapped up. Larissa, thank you so much, and I look forward to the next one we do together.
Me as well. Thank you, Corey. Take care.